Here's a simple rule of modern business. If your company needs buildings, thousands of employees, and office hours, and your competitor is just software, you're cooked. We've seen this movie before. Taxi companies didn't think an app could replace them. Then Uber showed up. Retail didn't think people would stop going to stores. Then Amazon showed up. Blockbuster had thousands of locations, late fees, and market dominance. Netflix had servers. Every time the same thing happens. Software removes the buildings. Software removes the staff. Software removes the friction. And once the cost structure collapses, the old system doesn't compete. It slowly bleeds out. Now apply that rule to finance. Banks run on skyscrapers, branch networks, compliance departments, and legacy systems held together by patches and people. The new financial system runs on code. No branches, no office hours, no physical infrastructure. Just global software moving money 24/7. This isn't a crypto story. This is a cost story. And when a high-cost system runs into a low-cost software alternative, the outcome is never a debate, but a countdown. To understand why this matters, you have to look at the economics. A modern bank isn't just a financial institution, it's a massive operating machine. Headquarters in expensive cities, hundreds of thousands of branches, layers of management, compliance teams, risk committees, IT departments maintaining systems that were built decades ago and patched ever since. All of that costs a lot of money. On average, large banks spend more than 60 cents to generate $1 of revenue. Think about what that means. Before a bank makes a single dollar of profit, more than half of it is already gone into salaries, real estate, infrastructure, and regulatory overhead. Now compare that to the new model. Stablecoin issuers moving hundreds of billions with a few hundred employees. DeFi protocols processing massive volumes with small teams and no physical presence. No branches, no buildings, no office hours, no paper pushers. That's the difference between a financial institution and a software product. And when two systems compete, the one with the lower cost structure doesn't just win on efficiency, it wins on price, it wins on speed, and over time, it wins market share. There was a time when the bank branch was essential. If you wanted to deposit money, get a loan, send a transfer, or solve a problem, you had to walk in, wait in line, and talk to a human. The branch was the distribution system for money. Today, it's mostly a cost center. Unless you're a boomer, when was the last time you went into a bank branch? Most people don't. They use apps. They transfer money online. They open accounts digitally. The behavior has already changed. The old infrastructure just hasn't caught up yet. And the numbers show it. Since the global financial crisis, bank branches have been closing year after year. Not because banks want to shrink, but because the economics no longer make sense. Every branch means rent, security, staff, cash holdings, insurance, and maintenance. In a digital world, that's like running a Blockbuster store for money. Branches used to be an advantage. Now they're just overhead. And overhead is exactly what software is designed to eliminate. The real pressure on banks and Wall Street isn't coming from one technology. It's coming from a trend that's been building for years. Everything in finance is getting cheaper. Trading commissions used to be a business. Now they're zero. Active managers used to charge 1 to 2% to beat the market. Most don't, and investors are moving to low-cost index funds instead. ETF fees keep dropping. Every year, the price of financial services goes down. That's what happens when a service becomes digital. It turns into commodity. And the next step is obvious. If assets move on-chain, you get markets that run 24/7. Instant settlement, fractional ownership, no clearinghouses, no layers of intermediaries taking a cut at every step. That's the nightmare scenario for Wall Street, because once finance becomes software, the question is no longer who provides the service. The question becomes, why pay anyone at all? When people think about disruption, they imagine a dramatic moment, end times predictions, panic, an industry collapsing overnight. But that's not how it really works. Real disruption looks boring. It shows up as branch closures. Hiring freezes, layoffs, smaller bonuses, departments getting merged, costs getting cut year after year. The system doesn't break, it slowly shrinks. And you can already see the pattern. Fewer branches, consolidations across the industry, inflation-adjusted compensation going nowhere, banks trying to maintain profits by cutting expenses instead of growing. This is what secular decline looks like. Newspapers didn't disappear the day the internet arrived. They made money for years after, but every year the margins got thinner, the staff got smaller, and the business got weaker. Industries don't die with a bang. They die slowly, one cost-cutting measure at a time. This doesn't mean banks disappear tomorrow. They're not going anywhere next year, or even in the next decade. The old system will stick around for a long time, but the direction of the system matters more than the timeline. Money, activity, and innovation are moving toward a digital infrastructure. from branches to apps, from office hours to always on markets, from institutions to software. And the smart move isn't to make a dramatic bet, it's to adjust your exposure. Use banks for what they're good at, salary, mortgages, basic infrastructure, but start spending more of your time where the future is being built. Hold some tokens, learn the tools, understand how the new system works. Get comfortable with self-ownership. The biggest risk isn't being early to the new system, it's building your financial life inside the one that's slowly becoming obsolete.